As we look at the charts right now, the U.S. markets are currently paused for the Thanksgiving holiday break, which means the numbers on your screen are locked in from the closing bell of the last active session. The price of NEO Inc., ADR, New York Stock Exchange NEO, sits at exactly 5.46 USD. In that last trading session leading into the holiday, we saw a decline of 0.04 USD, translating to a downward move of roughly 0.73%. However, that small percentage hides a much more volatile reality that played out over the last few days. If you zoom out just 48 hours prior to the holiday close, the stock took a significant hit, dropping heavily despite what, on paper, looked like a record-breaking earnings report. This specific disconnect, where the company delivers its best numbers in years and the stock price responds by stumbling, is exactly where we need to focus our attention today. It creates a tension that confuses the average retail trader, but often signals opportunity for the institutional players watching from the sidelines. Most people looking at this chart see a stock stuck in the mid-$5 range and assume the company is stagnant. That is the expectation. The narrative floating around social media and the headlines is that the Chinese EV market is too crowded, tariffs are looming, and profitability is a pipe dream. But here's the reality that challenges that view. NEO just posted its highest quarterly delivery volume in history. Its gross margins have rebounded to levels we have not seen in 3 years, and they are aggressively launching 2 new sub-brands that completely change their addressable market. When you see a stock price disconnect this severely from its improving fundamentals, you are witnessing a market inefficiency. The crowd is selling the past, while the smart money is trying to price in a future that includes not just high-end luxury cars, but a mass-market global footprint. Let's analyze the immediate price action we saw before the holiday closure. The stock closed at 5.46 USD, but it tested lows near 5.30 USD during the intraday churn on Wednesday. This 5.30 level is becoming a critical psychological floor. If you are using a platform like Robinhood Stock Trading to track your positions, you might have seen a flurry of notifications as the price dipped. This volatility was driven by a classic sell the news event following the Q3 earnings release. The volume was massive. Over 85 million shares changed hands in a single session. To put that in perspective, that's significantly higher than the average daily volume, indicating that institutions were rebalancing their portfolios ahead of the holiday. They were digesting the guidance, which, while strong, came with a side of caution regarding the fourth quarter due to subsidy changes in China. When you look at the broader sector, this movement makes more sense. Compare this to Tesla stock, which has been riding a different wave of optimism post-election. Tesla acts as the rising tide that usually lifts all EV boats. But right now, there's a decoupling happening. Investors are becoming highly selective. They're not just buying EVs anymore. They're buying specific business models. For a long time, the market treated NEO like a tech startup that happened to sell cars. Now, with the launch of Onvo and Firefly brands, the market is trying to figure out if NEO is becoming a manufacturing giant or if it's spreading itself too thin. This uncertainty is what pins the stock at 5.46 USD, but it's also what creates the potential for a breakout if the execution matches the ambition. We need to discuss the earnings report that dropped just before the holiday because the reaction to it was perplexing to many. NEO delivered over 87,000 vehicles in the third quarter. That's a 41% increase year over year. If you hold shares in a Fidelity brokerage account or track this through your Schwab Intelligent portfolios, you generally look for growth, and 41% growth is the kind of number that usually sends a stock soaring. Revenue hit 3.06 billion USD, and critically, the net loss narrowed by a massive margin compared to last year. The company is bleeding less cash while selling more cars. That is the definition of operating leverage. So why the drop to 5.46 USD? It comes down to the guidance. The market wanted to hear that Q4 would be even bigger, perhaps hitting 130,000 or 140,000 units. Instead, management guided for 120,000 to 125,000 units. Now pause for a second and think about that. They're guiding for another record quarter, representing almost 70% growth year over year. And the market punished them for it. This is the expectation trap. The expectations were set so astronomically high that excellent looked like a disappointment. This brings us to the most interesting development that most casual observers are missing: the sub-brand strategy. If you are just trading NIO as a luxury play, you're missing the bigger picture. NIO is effectively splitting its identity. The main NIO brand remains the premium high-margin competitor to BMW and Mercedes. But the new Onvo brand, which launched its L60 model recently, is attacking the mass market where the real volume lives. The L60 is delivering over 5,000 units a month already, and the L90 has been the top-selling large pure electric SUV in China for 3 months. This is not a future plan. This is happening right now. Then you have the Firefly brand. Just days ago, news broke that Firefly has started mass production of right-hand drive models specifically for export to Singapore, with the UK and Thailand on the docket for 2026. This is crucial because it allows NIO to bypass some of the fiercest competition in mainland China and tap into international markets with a lower-cost vehicle that avoids the high tariff brackets of the luxury segment. The skepticism around NIO has always been about cash burn. "They spend too much" is the common refrain you'll hear if you discuss this on an Interactive Brokers trading forum or a Reddit thread. And for a long time, that was true. They built massive NIO houses, essentially luxury clubhouses for owners, and deployed thousands of battery swap stations. Critics called it wasteful. However, the reality is shifting. Those battery swap stations are now performing over 100,000 swaps a day. It's becoming a habit for the user base, creating a moat that no other EV maker has. When you buy a Tesla, you're locked into the supercharger network, which is great, but it still takes time to charge. When you buy a NIO, you can swap a battery in 3 minutes. This infrastructure is capital-intensive upfront, but it pays dividends in customer retention. The Q3 numbers showed that service revenue is growing, meaning the infrastructure is starting to pay for itself. Let's talk about the specific price levels to watch when the markets reopen. We're sitting at 5.46 USD. The immediate resistance is at 5.80 USD. If the stock can push past that, there's a gap up to 6.20 USD that could fill very quickly. On the downside, if that 5.30 floor breaks, we could see a flush down to 5.00 USD, which would likely trigger a lot of stop-loss orders from retail traders using Robinhood cash management accounts or similar setups. However, looking at the institutional activity, we're seeing accumulation in this range. Big funds are not selling here. They're buying the dip. They understand that the fourth quarter is going to show a massive revenue jump because of the full quarter contribution of the Onvo sales. We also have to address the elephant in the room: geopolitics. The relationship between the US, Europe, and China is tense. Tariffs are the weapon of choice right now. The European Union has imposed tariffs on Chinese EVs, and there's constant fear that the US will tighten restrictions further. This macro fear is a wet blanket on the stock price. It keeps the valuation compressed. NIO is trading at a price-to-sales ratio that is incredibly low compared to its historical average and its peers. If you are a value investor using SoFi Investing or Fidelity Wealth Management tools to screen for undervalued growth, NIO pops up on the radar. The market is pricing in a worst-case scenario for tariffs. If the reality turns out to be even slightly less severe, for example, if the Firefly brand finds a loophole, or if local manufacturing partnerships like the one just announced with Thonburi in Thailand succeed, the stock has immense room to re-rate upwards. Speaking of Thailand, the partnership with the Thonburi Group was a strategic masterstroke that went largely unnoticed during the holiday noise. Thonburi is not a small player. They're a major assembly partner for Mercedes-Benz in the region. By partnering with them, NIO is securing a foothold in Southeast Asia with a partner that knows how to build premium cars. This allows them to deploy the Onvo and Firefly brands in a growing market without having to build a factory from scratch immediately. It's an asset-light expansion strategy that directly counters the argument that NIO spends too much money. It shows management is maturing and prioritizing capital efficiency. Now, I want to pause here and ask you a question, because this divides the community every time it comes up. The battery swap technology is NIO's signature feature, but some argue fast charging will eventually make it obsolete. Comment below with your take. Do you think battery swapping is the ultimate long-term solution for EVs, or is it just a bridge technology until charging speeds get faster? I want to see how many of you are holding shares specifically because of this tech versus those who are skeptical of it. Getting back to the analysis, we have to look at the competitive landscape. You have Li Auto, which focuses